You've probably heard that rich people don't pay any taxes, like Donald Trump talks about how he doesn't pay any tax, and Robert Kiyosaki talks about how he doesn't pay any tax. And that's why today I'm sitting down with my accountant, Khalil Dabaja, to talk about how, number one, wealthy people pay little to no money in taxes legally, and then we're going to be talking about number two, how you can use some of these loopholes legally to pay less money in taxes. So you want to definitely watch this video until the end. There's a ton of value in this video. And of course, if you have specific tax questions, talk to a licensed tax advisor in your area. With that, let's jump right in because the power's out in my office. There's a lot of people who talk about how can you make more money. But one of the things you talk about is it's not enough to just make more money. You got to keep the money you make. Why is that so important?
Because anybody can make money. Because if you're making $1 million a year and you end up living check to check, the guy who's making $100,000 a year and has $25,000 saved is more wealthy than you.
And so what's the key to somebody being able to keep more of their money?
What people don't realize is taxes are one of your largest expenses. It's one of your largest bills. We factor in groceries, we factor in the mortgage, we factor in utilities, we factor in car notes, insurance, but nobody factors in taxes because what the government does is they take your money before you receive it. But as an employee and as a business owner, there are ways where you can determine how much tax you want to pay.
You can determine how much tax you want to pay.
Yeah.
Is it legal to not pay your taxes?
You control your destiny. There's a big misconception out there where they think, oh, the government's just taxing us to death. But what they don't realize is this is what wealthy people do. They determine their future. They determine how much tax they want to pay. And yes, it's legal to answer your question because there's tax avoidance and there's tax evasion. Tax avoidance is perfectly legal. This is what the wealthy do. Tax evasion is what gets you locked up and behind bars.
So tax avoiding is how you can not pay taxes legally. Do you have to be wealthy to be able to avoid paying taxes?
The more money you make, the more leverage you have. So if you're a wealthy individual, there's more leverage that you have in determining how much tax you want to pay because there's more rules that you can follow. There's a playbook. Now, employees are a little bit more restricted, but whether you're earning under $150,000 or over $1 million, there are still items in the tax code that allow you to determine how much tax you want to pay. For example, if you're an employee and you work for a corporation, many corporations get a bad rep. You know, it's corporate America. They overwork you. But if you're an employee, there are benefits that you could take advantage of. For example, 401ks, HSAs, or any other retirement vehicles that the corporation can either match or offer you. And if you take advantage of those, there's ways where you can fund those retirement funds pre-tax.
I see. So let's go through a couple scenarios because I think somebody who's watching this, maybe they're making $50,000 a year, $250,000, $500,000, or $5 million. What steps, like if there's 3 steps that somebody can do today to pay little to no money in taxes and not go to jail, what are those things that somebody can do?
So as I mentioned, there's tax avoidance and there's tax evasion. You want to focus on tax avoidance, which means there's a playbook out there. And what the wealthy do is they follow the rules. They play the game by the rules, just like in sports. And the tax code is designed for you as an employee or as a business owner to follow and take advantage of. Okay? So there are 2 main reasons why the wealthy pay less taxes. Number 1, if they're entrepreneurs or business owners, they're providing jobs for the labor force. Or number 2, they're investing in real estate and providing housing for the general public. Now, if the wealthy entrepreneurs or business owners did not provide jobs or housing, they wouldn't be incentivized by the government because then the government would have to take on that burden, that responsibility to focus on labor and the housing market. But because entrepreneurs are taking on the risk and providing opportunities for employees to work, to make money, to support their families, and they're also providing investors opportunities to invest in real estate, the government is incentivizing them to pay the least amount of taxes by following the tax code.
I see. So now let's go through the scenario. If someone's watching this, they're making $50,000 to $500,000 a year. What steps would they do? Would you recommend they do? Should they go out and get an accountant? What should they do today or tomorrow that way next time they file their tax bill, they can maximize their deductions, their write-offs, and keep more money for themselves? Because like what you were saying, if you're an employee, right? Let's assume that someone's an employee now. The government takes your taxes before you even see the money. right? Versus if you're a business owner, it's a little bit different. I want to talk about that with you too. So if you already paid the money as an employee, are there things you can do, or should you do something else with their money, invest it to get the tax break somewhere else?
As an employee, you do have options, but they're limited. They're not like being an entrepreneur where you determine how much tax you want to pay. But as an employee, what you should do is try to find ways to generate losses, not monetary losses, but losses on paper. Ways in doing that are investing in real estate, especially if you're under $150,000 in income. Because if you're under $150,000 in income, you could benefit from real estate losses up to $25,000. Where if you're making more than $150,000 in income, you can't tap into those losses. You'd have to carry them forward. So what I would suggest is if you're making between $50,000 to $150,000 as an employee, maximize 401ks. Take advantage of HSAs that are offered by your corporation. Invest in rental real estate. Try to get financing where you could save some of your money, use that as a down payment, and leverage the bank's money to purchase some real estate. Rent those properties out, or you could work on flips if you're at that under 150,000. What's also beneficial is we believe as accountants, as tax advisors, entrepreneurs ourselves, even if you're an employee, you should have a side hustle. You should create a business. And what's interesting is there are no limitations on Form Schedule C. So if you're a sole proprietor, you have this passion of yours that, you know what, I want to continue working out at my job. I enjoy working for my company, but at the same time, I have a passion for helping others or possibly getting into a business that's similar to a hobby. You can generate income from this business, but more importantly, generate losses by starting to focus on your branding, your social media, your equipment, or some maybe technology expenses that you'll need for this hobby or business. And what's interesting is you can use that upfront investment. Let's say you invest $10,000 to $15,000 in this startup. You can use that loss in year one to offset much of your W-2 income. So the income that you've paid tax on throughout the year, between $50,000 to $150,000, you're paying tax on that dollar amount. But if you have losses through real estate or through a side hobby business on Schedule C, you can offset that income by taking that loss. But it's important to note that Schedule Cs are the most heavily audited tax forms. And that's another reason why the IRS, they put this microscope on self-employed individuals, where being self-employed is just maybe the introductory entrance in becoming a business owner. But if you're serious about doing business, you definitely want to take more of a legal approach and create a legal entity to separate yourself personally from the business.
Okay, so there's a couple things I want to dig into because there's a lot of value in what you just said. I want to talk about the real estate part, but maybe we'll save that for a little bit. What is a Form Schedule C?
So Form Schedule C is a profit and loss form that's filed on your personal 1040. Okay. So your business and your personal taxes are filed on one document. Now, you could be a Form Schedule C sole proprietor and still have an LLC. You're just a single member LLC.
Okay.
But the LLC is a disregarded entity. So the IRS still considers you the member and sole owner of your business. Now, we've seen Schedule Cs that generate $10, $15, $20 million in income. But that was a huge red flag to us. And for example, we had this client who was filing his wholesale business on his personal tax returns. And his net income would be close to $1 million a year. And we advised the client that, hey, you're overpaying about $30,000 a year in self-employment taxes. You've been a sole proprietor filing your business on Form Schedule C for almost 10 years. Like, you've paid over $1 million in self-employment taxes than you had to. And all you needed to do was file Form 2553 to elect to be treated as an S Corp. What's interesting as well is filing your business and your personal tax return on one document exposes you to more audit risk. So they are the most heavily audited forms with the IRS. And what the IRS does is when they see that your business and your personal tax returns are filed on Form 1040, they ask for personal bank statements and they also ask for business bank statements. But if you're filing as, let's say, an S Corp or a C Corp or a partnership, these are separate entities where your business is more subject to exposure.
So if I break that down, so if I wanted to go out, let's say I wanted to sell cupcakes. If I just started selling them to my neighbors, I didn't create any entity. I didn't create an LLC. I just went out and started selling cupcakes to my neighbors. and I invested $1,000 in getting the materials. I went to the grocery store, Walmart, and I bought some stuff. Now I take these cupcakes and let's say I make $5,000, right? So because it didn't create an LLC, so this is going to go on a Schedule C. Is that correct?
Correct.
And now if I said, you know what, I want to turn this into a real legitimate business, maybe I go out and create an LLC. Maybe I do it myself, I get an attorney. Now, if I create an LLC, this is not me, this is my business that's selling it now. You're saying that if I'm the only owner of the LLC, it's kind of the same thing from a tax perspective?
From a tax perspective, there's no benefit to creating an LLC versus just remaining as a sole proprietor.
Okay.
The LLC is beneficial when it comes to legal purposes and for accounting purposes. Priority number one is separate the entity for legal purposes. What if your neighbor chokes on that cupcake and she wants to come after your personal assets? Yeah. She's going to come after your personal assets, such like your home. Not a friendly neighbor, right?
Yeah.
But if you separate and create a legal entity, now your neighbor can only come after what the legal entity owns and not what Jaspreet owns personally.
Sure. So now let's dig into the financial side. So now let's go through that same scenario. Let's assume that I make $75,000 a year. I spent $1,000 now buying this cupcake stuff, but nobody buys it. I lost $1,000 in this business. Can I take that $1,000 that I spent at Walmart getting my cupcake materials, maybe ran some advertisements or whatnot? Can I now tell the IRS, I spent $1,000 building this business, but I lost it?
Absolutely, absolutely. And documentation is key. So as long as you are actively pursuing creating a business and you document through itemized receipts, you can take that loss.
So this is where I think there's a lot of value now, because if I'm an employee, I make $40,000, $50,000, $500,000 a year. I think a lot of people nowadays, especially in today's culture, have some sort of side hustle, right? So if you're spending money on this side hustle, you're saying we got to keep these receipts. And then when we go to file our taxes, if we don't have an accountant, write these things down on something called the Schedule C and say, hey, IRS, I made $75,000, but I spent $5,000 in this business and made no money, or I lost $5,000. Now I can pay less money in taxes or get a bigger refund.
Correct. So as an employee, let's say you're on that $75,000 price point, you may not need an accountant that is providing you with monthly, quarterly financials, tax planning throughout the year, but it's important to document your records through a spreadsheet at the very minimum. Okay. Now, when you're actively pursuing this business, you want to document your mileage,
Mileage, like how much, what does that mean?
So for example, if you're going to Walmart to purchase supplies for your business, that drive from your first business stop, so not from home to Walmart, but if you go to buy some pens or supplies from Office Max or Staples.
What about a cell phone for my business?
Your cell phone is deductible as well, the business portion. So let's say 50% of your cell phone bill, you use your phone to text or speak with clients 50% of the time, you can take a $50 deduction if your phone bill is $100 a month. So, and we could talk about, there are so many deductions that entrepreneurs don't even realize, or even employees, that they can tap into because they're actively seeking to grow a business. So as an employee, many employees are considered consultants, right? And the IRS is aware of this. But if you can document your cell phone bill, your automobile expenses, if you're driving client to client or customer to customer, or you're picking up some supplies, if you could document the supplies or even the meals that you have with potential clients or leads or vendors that you meet with, the insurance, some travel is also deductible. If you could document this, this is your golden ticket, because now the IRS, they're going to say you're innocent until proven guilty. So we're auditing you. We're sending you this letter that we are going to audit you, but we're going to request documentation. And if you beat them to the punch and provide them with the documentation to support your deductions and your losses that helped offset your W-2 income, which you already paid taxes on, which help you gain a larger refund that you could either take or carry forward into future years, you've done your part. You've given them the proof. They're not even going to waste their time at that point. And I'm speaking from experience. I've been through these audits. I know what the IRS looks for. And there are lifestyle deductions that you can tap into, because let's face it, the world has changed, and we're using our cell phones, we're using our vehicles, we're using our home, we're traveling a lot more. And you can take advantage of these deductions as well, as long as they're documented.
So this is super interesting because now okay, so I'm going to go back to this cupcake example. So now if I'm an employee making $75,000 a year, what does it take for me to justify that I have a cupcake business? Like what if I say I want to start a cupcake business and now I go out and buy the supplies, but then it's like, it's very easy to come up with a business idea and spend money, right? That's the easy part.
Absolutely.
But when does it take to actually qualify for the deduction?
Jaspreet, this is perfect timing. Yesterday, I received a phone call from a client out from New York, and they are considering investing in remodeling their kitchen. Mm-hmm. And his question to me was, Khalil, can I write off a portion of the remodel for this kitchen? And I said, well, for your company, you're not in the food or beverage industry, so unfortunately, there's nothing that you can really do to tap into your kitchen. Then he mentioned, Khalil, my wife is involved in this social media brand where she's helping people with autoimmune disease or other gut issues with a diet plan, meal prep, and consulting on ways where they can heal themselves naturally, holistically through food, as opposed to the medicinal route.
Yeah.
So when he said that to me, a light bulb went off in my head. I said, look, now we're talking. There's a portion that you can take. It has to be at least 50% for you to tap into. So if you're spending $100,000 on a kitchen, it has to be reasonable, ordinary and necessary. And it also has to be reasonable. Now, you can take, as long as it's documented, when you're creating content, when you are using your range, your refrigerator, your countertop, you are having clients or customers come to your house and you're feeding them or giving them a culinary experience, that's considered a business deduction.
So you're telling me,
you can tap into that.
I want to dig this because
it's a little bit more advanced than the cupcakes.
Yeah. So let's go and stick with that. I'm making $75,000 a year.
Right.
I have this cupcake business idea, but instead of just knocking door to door, I want to teach how to make cupcakes on Instagram and YouTube, right? So now you're saying if I want to upgrade my kitchen, this kitchen upgrade now can become a business expense?
So it's not black and white. Here's why. Because there's still personal usage of this kitchen. And if you're going to expense this kitchen through depreciation, if you sell the home, you're going to have to add back that expense that you took.
Okay.
So, but it could be beneficial in the short run. Now, I know many clients who say, look, times have changed. I'm working from home. I don't ever see myself working from an office.
Yeah.
So yes, I'm okay with depreciating my kitchen remodel or the business use of my kitchen remodel, and I'll add that back when I sell the home as depreciation, or I'll just, I'll take advantage of the fact that I can make up to $250,000 or $500,000 tax-free when I sell my primary residence, and if depreciation was $50,000 that I have to add back, it doesn't take over my tax-free incentive.
And depreciation is what? That means the write-off?
The write-off. So when you are investing in a fixed asset, you don't just write off the asset as an ordinary expense. It has to be capitalized over a specific period of time.
Okay, let's explain that now in English. So so depreciation, capital expense, fixed asset, what does that mean?
So if you're a business owner,
yeah,
you're buying equipment, you're buying computers, laptops.
And by business owner, you mean now whether I'm making 75 grand and I want to start a cupcake business or a real, I have a business.
Exactly,
okay.
Exactly. This is just, we're talking about extra zeros, because at the end of the day, whether you're making 75,000 or 7.5 million, it's very similar. Mm-hmm. It's just obviously you have more leverage once you get to that level.
I see.
But when you are investing in remodels, construction, electrical, plumbing, any fixtures, you can't just write off the assets. They have an asset life.
Okay.
So for example, vehicles are written off over 5 years. Leasehold improvements like the moldings that you see here are written off over 15 years.
So if I buy a $50,000 car,
yes,
right, and I was going to write off 100% of the car, I can't take a $50,000, if I made $100,000 this year, I bought a $50,000 car, I can only take a $10,000 deduction this year, $10,000 next year, $10,000 the year after that. Is that what you're saying?
Unless you tap into bonus depreciation in Section 179. So for example, for your cupcake business, you buy a fleet truck. Mm-hmm. Right? And it's advertised Jaspreet's cupcake business. When you're not going to drive this vehicle to a wedding, you're not going to drive it hanging out with your buddies. You are this business vehicle is 100% business use.
Yeah.
You even have an oven in there.
Okay.
And you are selling, you're going, you started off with your neighbor, but
Yeah.
now you're driving around the neighborhood locally, and now you're selling your cupcakes door to door. That company vehicle is 100% deductible. And you could take bonus depreciation in year one. It used to be 100%, but now it's phased out to about 80%. So if the vehicle costs you $50,000, you could take 80% of that as a deduction in year one and then capitalize the rest over 5 years.
So this is where it's very valuable to have a good accountant, because now I can see like a lot of people watching this saying, I need to go and start a cupcake business. But this is where things get very complex, right? Because now as soon as what you were saying is if you file the Schedule C, you make 75 grand a year, you go out and start a business, and now you start taking your Walmart receipts and you use that to deduct your taxes, you open yourself up to potentially getting in trouble with the IRS. The way you protect yourself from getting in trouble is, number one, you document it. You get the receipts and you take notes on the receipts of why you bought it and what you bought it for. And then number two, I would assume as you start to grow, you get a good advisor accountant who can help guide you and track and manage and tell you how much you can deduct. Would you agree with that?
Absolutely. There are many levels to the time necessary to have an accountant. And that's factored by your revenue and the amount of pain that you feel paying taxes. So what's your pain tolerance?
Yeah.
I speak to business owners across the country. All of our clients are business owners throughout the country. And there are different levels. We encourage, so some of the phone calls we get are it's a complimentary call giving advice to people who are just starting off. And I have no problem saying, hey, look, at this time, you don't necessarily need an accountant. You don't need to have any tax planning yet. But there's going to be a time where we do cross that bridge.
Yeah.
But in the meantime, as an employee, you're making $75,000 or you just started your side hustle. Here's what I would suggest. Track all of your business income and expenses by creating a separate bank account.
Okay.
It could be a personal bank account that is separate from your other personal bank accounts where you pay all of your expenses from. But if you choose to create an LLC, that's kind of the beauty of creating an LLC, because you get to separate what your personal and business income and expenses are, and it's a lot easier to track for accounting purposes. But let's say you keep it a personal bank account where you could separate the income that you receive from customers and the expenses that you pay for supplies, gas, insurance, travel, meals, anything of that nature. Now, before having an accountant, before needing to have an accountant, check your bank statements on a monthly. You should check them daily, but as you grow, start checking them on a monthly basis. Start reconciling. Have an accounting software, or even use a spreadsheet where all the deposits that you're receiving are considered sales. All of the debits or checks that you write that exit or debit your account are considered business expenses. And track and categorize what those expenses are for. And at the end, you've just created a profit and loss statement that you could track throughout the year. Now, what's interesting is once you start making some money, you're going to have to pay quarterly taxes.
What is some money? How much money before?
Once you have a $1,000 or $1,500 tax liability at the end of each year, you must pay estimated quarterly taxes.
Even if you don't have an LLC?
Even if you're a W-2 employee.
Okay.
So, for example, you're an employee and your employer didn't withhold enough taxes based on how you filed your W-4. If you owe more than $1,000 or $1,500 at the end of each year, you're going to have to pay quarterly taxes.
I see.
Or else you're penalized for it. So if you're a business owner, you're responsible now for your taxes. There's no employer who's going to be kind enough to withhold your taxes and pay it to the government on your behalf. It's your responsibility now as a business owner, regardless of how much income you're generating, to track what your income is. And so you track your income to figure out what your tax liability is. So let's say your business ends up making $20,000 at the end of the year. That's great for a side hustle. It's almost $2,000 extra in additional supplemental income that you're making while you're still working full-time at your job. But what's important is that you pay your estimated taxes based on the federal income tax, your effective tax rate that you owe, and also what your state income tax rate is. And then you would pay those taxes 4 times a year throughout the year. And then when you file your taxes, it's important that if you're going to file your taxes on a software yourself, that you include what you've paid throughout the year. Or if you're going to meet with an accountant, you bring your spreadsheets that you've worked on throughout the year, the receipts that you documented throughout the year, and you're also going to provide them with the liabilities that you've the payments that you've made throughout the year, so they factor that when preparing your taxes. But that's the bare minimum elementary phase in starting a business. You need an accountant once you're making more than $250,000 in gross revenue. That's where it makes sense to invest in a team where now you don't have time to track your revenue and your expenses and your assets and your liabilities. Your goal as a business owner is to hire the right talent around you so they advise you on what you need to do based on your financial reporting, and they would discuss the data, the balance sheet, income statement of cash flow. They would provide those to you on a monthly basis. They would meet with you each quarter. You would tax plan with them, because at the end of the day, when you have an advisor on your team, as the CEO, you want to hire the right talent around you. They are reporting their findings to you as a CEO. So I would say, Jaspreet, here's what our findings are for this month. Here's what our tax liability is going to be for the quarter. Here are our recommendations in ways where we could reduce that liability.
Yeah.
So I feel like if you're under 250, you can handle it yourself. Be organized, track your data, track your business income and expenses. But once you're above that threshold, it makes sense to maybe outsource this to somebody that you could work with.
Yeah, now my recommendation, I don't recommend anything, but I would say even if you start sooner, it doesn't hurt if you can afford it. But if we kind of summarize now for an employee, because I know you work with a lot of high net worth individuals, and I want to dig into like some of these hidden tax codes that like the wealthy are using to pay no money in taxes. But if you are an employee and you're making $50,000 to even $500,000 a year, so the strategies you said are essentially, number one is maximize the tax deferred accounts, 401k, IRA, HSA. Number two is to use real estate as rental properties that you can use to qualify for more deductions. And number three is essentially create your own side hustle and use the tax codes to reduce the expenses in the side hustle. But now, let's assume that somebody has a business. You're an entrepreneur, or you are a real estate investor. Are those considered different in the eyes of an IRS, or would that be the same category first?
It would be the same category, but there are different types of classifications of investors.
Okay.
And there's active investors, passive investors, and real estate professionals.
So let's start with real estate investors, because a lot of people that watch this channel are investing in real estate. If you're investing in real estate, whether single-family homes, apartment complexes, like how do you know that you are not overpaying in taxes, and what are some strategies that somebody can start using to pay less money in taxes as a real estate investor?
Some of the wealthiest individuals in the world are real estate investors, because real estate appreciates and it depreciates. So the investor is able to tap into the best of both worlds. Now, if you are an employee, okay, I'll give you a few scenarios. You're an employee, you're making under $150,000. You are able to tap into the benefits of investing in real estate each year. So if you're renting out your property and you're collecting rental income, and let's say you make, so you're collecting your rental income, after all of your expenses, you have a $10,000 profit. So you're almost clearing, $1,000 a month. Let's call it simple math. Now, what's interesting is you're not out of pocket the purchase price of the home. You finance, hopefully with good terms, you finance the property. Depreciation completely wipes out your income strategically. So let's say you have a $10,000, let's call it one rental property, and you have a $10,000 income. But your depreciation, the purchase price of the home that you've been able to deduct over 27 and a half years, the life of the asset, is about $10,000. It wipes out your income. So on paper, you'd have no income. You just generated $10,000 of income without paying tax on it.
So this is what you call a paper loss.
So this is a paper loss. And when we speak of losses, nobody wants to lose money. You also don't want to burn your money. You don't want to invest in a business that's going to fail. And a lot of that has, you see that on social media where you can just buy this or invest in this, but people forget you have to make the money first in order to do that. And you also don't want to just light your profits on fire. You need to be, if they follow you, Jaspreet, and if they listen to you, you give great advice so they know what to do with that money. Now, if you're under $150,000, you can tap into it. But if you're over $150,000, you would have to carry forward the losses each year until you sell the asset.
Okay.
Now, the real estate professional is someone like, let's call it Donald Trump. He was able to tap into, I believe it was like a million or something outrageous depreciation expense over years, right? Where he's not out of pocket, he's leveraged the banks, but he's able to offset much of his income because he was considered a real estate professional. So real estate professionals are a designation that the IRS gives individuals who are only invested in real estate. They're not physicians, or they don't have jobs where they have their W-2 job during the day, but they invest in real estate. You could call it actively or passively. They are real estate agents, real estate investors. They are making all of their income. They are actively participating as a real estate professional. When you're considered a real estate professional, there are no limitations. So, but it's extremely difficult to be classified as a real estate professional if you have a job and then you're just investing in real estate.
So if I go out and invest in real estate, I buy a single family home, I'm making $75,000 a year, and I lose money, not because I don't have money in my bank, but because I take this depreciation deduction. So the property is 1 year older, I get to take a deduction because of the value of the property. Now, let's just say on paper, I tell the IRS I lost $5,000 when in actuality I have $5,000 in my bank. I made $5,000. I tell the IRS I lost $5,000. Now, if I'm making under $150,000, that means I can take that $5,000 paper loss, and instead of paying my taxes on my $75,000 of income, I only pay taxes on $70,000 of income. Is that correct?
Exactly.
But then if I make over $150,000, I can't do that.
You can't take that loss. It would carry forward in future years.
So now if next year I made $20,000 and I can only write off $10,000 on my taxes, or I take the $10,000 depreciation, I still have $10,000 of income. I take the $5,000 loss from last year,
exactly,
and use it against this.
As long as that year your income was under $150,000.
Now over $150,000. Right?
Under $150,000. So you can. So let's say you're over $150,000.
Okay.
But 1 year, your commissions weren't as high. So now you're at under 100. You can tap into those losses that you had from previous years.
But what if now I have a gain not from my income, not my job, but my rental property, right? So I took a loss this year. I have a $5,000 loss on my rental property portfolio this year on paper. Next year, I have a $10,000 gain on my real estate portfolio on paper. Can I take this year's $5,000 loss and take it against next year's gain?
You can take it against next year's gain as long as your overall income is under $150,000.
Interesting.
Yes.
And so now, in order to qualify for more gains, I need to be a real estate professional, like Donald Trump. Somebody who is actively working in real estate. This is what you do full time, not somebody who does real estate on the side. Because I've heard a lot of people talk about the real estate professional designation, right? Where you can qualify for more tax losses, bigger tax breaks and all that. But if I work a job, like I have a realtor's license, but I have my own business. I run Briefs Media. I can't qualify for...
Unfortunately, you wouldn't be able to qualify for that designation. But you could qualify for a passive investor, which still has benefits. But the real estate professional is somebody who's full-time. And that's why it's so hard to get that, qualify for that designation. But you would have to be 100% all in as a real estate professional. But I've seen scenarios where strategically spouses become the real estate professional, where they are 100% all in as a real estate professional, and they're able to use their losses to offset the other spouse's income, even if they're over $150,000.
So now if somebody has a business, their spouse, let's just say, doesn't work. And if they now become the property manager, the person who's looking for properties, they could then qualify as a real estate professional. Is that correct?
They could qualify as long as they're able to document the amount of hours and log what they're actively doing. Documentation is the key to everything.
Okay.
Because at the end of the day, you need proof to show the IRS why you would qualify as a real estate professional.
I see. So now the spouse is the real estate professional. The other spouse is making millions of dollars a year in a business, so you don't qualify for the under $150,000 exemptions. And then you lose money on paper in your real estate. You could use those losses to offset the business gains.
Correct.
Interesting. So now, like, when people talk about like loopholes that wealthy people use, are there like real loopholes that are only available to like certain people or real estate investors? Like, what are those that people talk about?
The tax code is extremely complex document, okay? The wealthy can afford to hire accountants and attorneys to look into these loopholes.
Okay.
They're considered loopholes in mainstream terms, but all they are ways where accountants and tax attorneys who've been paid to find ways to navigate the tax code. That's literally what it comes down to. Now, the wealthy understand the rules of the game. They play the game by the rules, okay? As they're avoiding the taxes, which is legal. Now, it's important to understand Netflix and many of these corporations who pay $0 in taxes. Do we really think they're stuffing cash under a mattress? No, they're following the law and they're following the tax code. The tax code is designed to incentivize those entrepreneurs because they're stimulating the economy, as I mentioned earlier, with jobs and housing. What it comes down to is this. Do you feel like you could spend your hard-earned dollars better than the government can? Most people would say yes, absolutely. The government even says, these are the rules of the game, follow these rules, and this is how you determine how much tax you want to pay. The wealthy have leverage because they have resources that they can use to find these loopholes, right? But if you're a business owner, you definitely have more leverage in determining how much tax you want to pay as opposed to an employee.
So, like, for example, I know we're going into an election year. That's always when you hear about, the corporations, the wealthy corporations that don't pay their fair share in taxes. I know in the last election, I think Amazon was on the hot seat because Amazon's, multi-trillion-dollar company, and they make billions and billions of dollars and pay no money or have paid no money in taxes for a number of years. How then can a company like Amazon not pay taxes? Is that fair?
I'm an accountant, I'm a tax advisor. From my perspective, I think they're just playing the game better than many other individuals and entities. They're a conglomerate. They have unlimited resources. And when you have unlimited resources, not only can you hire the best accountants and tax professionals, but you also can lobby for tax incentives, tax breaks. Now, something we have to remember is this. Everybody thinks if you're rich, you're evil. That's what they connect, right?
Yeah.
But let's look at and I'm not a spokesperson for any of these corporations. I have my own thoughts on that.
I know you got your own clients you're working with. Yeah, no, I get it.
So, but look at the amount of jobs that Amazon is generating. Look at the customer service. Look at the fact that we can order something off of our phone. You are directly paid based on how you impact individuals. So if they're making life more convenient for the consumer, maybe it's our fault for getting so used to having things done so instantly and same day, right? But from a tax perspective, they're investing heavily in real estate, in equipment, in research and development, in labor. They're making our lifestyles a little bit more enjoyable and more gratifying, right? We have that instant gratification. We're not waiting long for our packages to arrive or having to go to a box chain store. But what Amazon is doing is they're paying millions, if not billions of dollars in taxes. It's just not income tax or corporate tax. They're paying property taxes. They're paying payroll taxes. They're paying, maybe excise taxes between, importing and exporting. But it's just they're avoiding paying corporate taxes. So
Amazon creates jobs for hundreds of thousands of people. Now, when you as an employee work for Amazon, which is interesting now because this is more, I guess, the tax theory. As an employee, if I made $100,000 in Amazon, I'm not going to take home $100,000, right? Because the government's going to take the taxes first. Maybe I take 70,000, something around there, depending on where I live. But in addition to that, Amazon isn't going to pay out 100,000. Right? Because they have to also pay payroll taxes to that person.
Correct. So Amazon is probably paying 110, 115,000. Plus, we have to think about benefits. So that employee is probably costing $150,000 because there's health insurance, there's life insurance, there's so many other benefits that they provide employees, and not just Amazon, but many entities to retain employees. Now, the payroll taxes that they pay, there's an employer portion and there's an employee portion. When you're receiving the net deposit annually of $70,000, box 2, so the federal taxes that you pay, they're paying you your gross amount. They're just taking a portion of that and they're paying it to the federal government before you see it. And then when you file your taxes, you're either paid in full or you owe a little bit more money, which means not enough income was withheld. You can control how much of that federal income tax or state income tax that you pay. What you can't control is Social Security, Medicare taxes, because those are set rates by the government where the employee pays a portion and the employer matches that portion. So it does cost Amazon or other even small businesses more to have employees on payroll.
Yeah, that's interesting because like I know even when I pay myself a salary, right? If I wanted to pay myself $100,000, I don't pay myself $100,000 to get $100,000. If I paid myself a salary of $100,000, out of my payroll, it's going to be $110,000, $115,000 that leaves my business account. But then I only hit $70,000 that might actually hit my actual personal account because now the business has to pay its employee, my business has to pay payroll taxes. Then Jaspreet Singh, as an employee, has to pay payroll taxes, so you're paying taxes twice. So somebody who is a business owner, you've probably seen that where you got to pay those taxes twice. Amazon as a corporation has to do the same thing. So you're saying that they're paying taxes. It's just the debate and the argument that a lot of people talk about is the corporate income taxes.
Correct. That's what they're not paying. And because they're investing so heavily in equipment, in real estate, they're able to, and even research and development, and there's even, I don't want to get too complex, but there's ways where you have your intangible assets that are offshore in a different country, and then this is what Apple does. They'll pay a royalty fee or a rent to the entity offshore to clear all of the profits that they're making.
Yeah.
So there are so many ways where these entities are just so much more creative because they have the resources. But as a business owner, as a small business owner, you don't have, or even as an employee, let's face it, we don't have unlimited resources that Amazon has. But we do have resources in our possession that we can tap into by just making the right decisions or working with the right advisors.
So let me ask you this now. So let's say, there's a big trend now of digital businesses, right? Like my Minority Mindset brand is a digital business. I could work in Detroit, I could work in California, I can work in Europe, India, it doesn't matter. So if somebody here is a creator or some sort of digital brand, e-commerce, you're on the internet, does it matter now where you incorporate your business? Like if you are a business in California, a high tax state versus, Florida or Texas, a lower tax state, or even recently I was in Estonia and we were talking about this. I met with the ex-prime minister of Estonia. And one of the things he was telling me is that they're really trying to encourage digital businesses to move out to Tallinn in Estonia, which is a city in Estonia. And the reason why and the way that they're incentivizing people to do that, he was trying to pitch me to move one of my businesses out there. He was saying, look, we have this rule. Now, don't quote me on this. I don't know. This is just what he told me. I could be wrong. That essentially, if you make a business, create a business, you have it in Estonia, and your business makes a profit, and your money leaves or sits in that account, you don't pay any taxes. So you can make a profit. Because if in America, if I made $100,000 in profit and I don't spend that money, I'm paying taxes on the $100,000. If he's saying that if I make the $100,000 in Estonia, right, I'm working around the world. But if my bank account's in Estonia or if my LLC or whatever entity is filed in Estonia, I don't pay any taxes. So now as a digital entrepreneur, can you play these games strategically like that?
It all depends on your residency. That's
Okay.
what it comes down to. So where do you live? Where do you sleep? Where do you spend the majority of your time? And I've found ways where even living in the US, people from California, New York, Michigan, they want that Florida residence. Why? Because there's no income tax in Florida. But the government would go as far as checking cell phone records to see what cell towers you're at to determine whether your residency is, if you truly are a resident of that state. So when it comes to the income tax that you pay, even though your entity is located in a foreign country, let's say Estonia, which has maybe more favorable tax law than the US, US tax code is based on global income. So it's one of the countries in the world where you're taxed as a citizen of the country on all worldwide income, whether you make it in foreign countries or not. Now, If you live in Estonia or you live in Dubai or other places around the world, you have a foreign tax income exemption, which means you could be a U.S. citizen and make a little bit over $100,000 living in these foreign countries where your income up to 100,000, changes with inflation, is not taxed. So you're exempt on paying taxes up to that level.
Wow.
But anything above that level, you're going to have to pay tax as a U.S. citizen.
Interesting. That's, it's funny you said that about the cell phone towers, because there's a whole thing going on right now. The IRS is trying to add, 40,000 or something agents. So you're saying that some of these agents are going to be looking at your cell phone records to see where you're living, to literally, because their job is to make sure, the IRS wants to make sure that you pay your quote unquote fair share. You're saying your fair share is what you decide to be your fair share. The IRS, so I'm an attorney, right? Not your attorney, but I am an attorney. One of the things I studied was the tax law. Nowhere near to the extent that you have, and it went in one ear, out the other ear now. But the tax law is complicated. IRS, it was like 2,000 pages long, the tax law. And what you're saying is you can strategically use rules to pay less money in taxes, and the IRS is just going to make sure that you use the rules. But that still means you can pay little to no money in taxes legally and still be completely free and clear, do nothing illegal, do nothing wrong, and the IRS can't do anything because you got the documentation.
You have the support. Now, there's a major difference when, unfortunately, I believe they're hiring like 80,000 agents, right?
Yeah.
Over a 10-year span, some of the current agents are retiring. I've worked with the IRS. I've had these face-to-face interactions.
How was that? You ever see the movie Wolf on Wall Street, where they put them in a room and you just put the AC on full blast? Is it kind of like that?
There's two philosophies. Number one, you put the AC on blast. You're rude. You're not, yes, no, maybe, you're an attorney. What is it? Yes, no, I don't know.
Yeah.
Type of responses.
Right.
So, or the other philosophy is you're a human being. You treat them as a person, because at the end of the day, they're citizens. The agents are citizens just like us. Mm-hmm. We choose that philosophy. Treat them kindly, speak with them, understand that we are relatable and we are working towards a common interest of the client, right? Now, we're willing to bet that because of our system that we've designed, that we have nothing to fear. Why? Because we have support for all of our deductions that we take. Now, if you don't have support, documentation, general ledgers, financial statements to support your deductions, of course you're going to be fearful. But for us, there is no fear, because this is what we do for a living. And the system that we've designed is almost like an insurance policy for our clients as well, because we're tracking all of the dollars coming in and all of the dollars coming out, not only for tax purposes to make sure that you only pay what you have to in taxes, but for banks, for investors, they go off of tax returns and financial statements when it comes to lending. You want to purchase a home, you're a business owner, they're going to ask for your pay stubs and they're going to ask for your financial statements.
Yeah, it's funny you said that, because a lot of my friends that I grew up with are entrepreneurs to some extent. And there's some people that, I don't know what the right word is, but in the technical term, they're solopreneurs, and growing up, you call them hustlers, right? These are people that they're not dealing drugs, but they're doing things and making money, right? And their sole goal is to not pay any money in taxes. And the problem is then when these same guys that I know want to go out and buy a home is, oh shoot, I got no income, right? I paid no taxes, but now I have no reported income. I can't get a mortgage. And so this is where, you have to be smart, and an advisor is really kind of there to guide you, because I think these are really important questions, because there are ways now you can pay less money in taxes as a paper deduction, but still have that income.
Exactly.
But then if you kind of go down, I'm just hustling, I'm making money, right? I'm DJing, I'm doing the photography, videography, I'm making money. And then you're making the money under the table, or you're doing things which are illegal, which you would recommend do not do that, I would assume.
Of course, absolutely.
So do not do that. That's where now yeah, you can pay no money in taxes, but you're also shooting yourself in the foot at the same time.
Exactly.
I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below.
Here's how the whole system's designed. In America, there's credit and there's taxes. As long as you have
I like that.
As long as you have good credit,
Yeah.
and you're profitable on paper through your taxes, you can have unlimited resources for lending, okay? Because we are a consumer-driven economy. The banks want, and you know, we want you to spend. We want you to buy homes. We want you to create businesses. And investors and the banks and institutions, even the government, will work with you to help you achieve that goal, as long as you have good credit and good sources of income. Now, there are many individuals who feel like they're hustling the system, or I'm getting refunds each year. You don't want to get a refund. You actually want to break even, because then you're just giving an interest-free loan to the government, or owe a little bit of money in taxes. Because if you owe money in taxes, it's a good sign you're making money. But strategically, you can receive refunds or not owe any money in taxes to the government on paper. So for example, you're a mortgage officer. Every time we release our tax returns on behalf of our clients or their financial statements, because remember, you're a business owner. The corporate world, your boss, your manager, the president of the company is no longer going to hold your hand and pay the taxes on your behalf. It's your responsibility now. You're the employer and the employee as a business owner. So you have to determine your payroll, how much tax you're going to pay, what your salary is going to be. And you also have to have a system in place that tracks all of your income and expenses in order to file your taxes properly. A lot of mistakes that entrepreneurs make is their financial statements don't match their tax returns. So when an opportunity arises, like your friend who wanted to get a mortgage, if the financial statements and the tax returns don't reflect each other, there's a huge discrepancy. And knowing that they were self-prepared and they weren't, it wasn't a third party or an outsourced firm who was preparing these documents, they're less likely to treat these as the more eligible qualifications for you to qualify for the mortgage. Now, from our perspective, it's important that you take advantage of the tax code by only paying what you have to in taxes. Depreciation is something that the banks add back. So for example, let's say you had $100,000 in profit for your business, but you had a $100,000 deduction in depreciation. Your taxes show zero income. But if you provide that tax return and that financial statement to lenders, the mortgage officers and the banks know that they can add back depreciation to qualify you for financing. So it's the best of both worlds. You saved on income tax, but you also qualified for financing because of that designation, where that's just what they do. They understand that you're not out of pocket. You were just able to tap into that code of the tax code in order to tap into that deduction. So there are many ways strategically where you don't necessarily have to make hundreds of thousands or millions of dollars to qualify for lending, but at the same time, you don't want to play the system where you're showing $20,000, $30,000 or if anything at all through taxes and expect that you're going to grow in this country. You're simply not. You're not going to qualify for anything. You may qualify for benefits from the government, but at the end of the day, that's going to keep you at bay. That's not going to allow you to grow. So no, I that makes a lot of sense, and I agree. One of the things I know working with you is my whole goal is, look, I like to play it safe, right? Because my big thing is I would rather not deal with the crap than pay a little bit extra and do things right. And that's where I like working with someone like you, where you're like, what, we know what we're doing, just let us kind of guide you. But one of the things you were saying earlier, which I kind of want to bring back to you, one of the things you mentioned was ordinary and necessary deductions. And the second thing you said was lifestyle expenses. And the reason why I want to talk about these two is because there's a lot of
influencers growing, right? A lot of people want to be influencers, content creators to some extent, whether you are a professional, whether an entity, or whether you're just starting off. How can now somebody as a content creator, fully established, making millions or making no money at all, start using the tax code to their advantage with these types of deductions?
As a content creator, you're a creator, you're creative, right? Accounting is a foreign language, let's face it. My experience comes from working with CPAs who've been doing this for 30 plus years, right? I started this business 10 years ago before even hopping into the social media realm. Mm-hmm. And correct, there are many, there's a lot of content out there in regards to, like, it's almost like that paralysis you get where there's just so much information coming at you, you don't even know where to start. Mm-hmm. What it truly comes down to is being able to relate to your content that I'm going to hire this individual or this team or this group, and they're going to look after my best interest. Your accountant must care. And too many times I've seen it in my career where it's not my money. I'm not the one paying taxes. Mm-hmm. This is what you owe. Mm-hmm. You're making money, just pay the bill. That doesn't sit well with me. And I experienced that.
Me neither.
Right? And it takes two to tango, and it's a two-way street working with us. But as an entrepreneur myself, this is how we operate our business. Like, we don't need to have an office this way, but we're business owners at the end of the day. So we treat every one of our clients' business as if it's ours. So there has to be that personal connection. So as a content creator or even as a business owner, if you can relate to your accountant on a human level, where you feel like this person cares about my interest and is going to look after my interest and is not going to compromise me, then that's the right person that you need to work with. Now, as a content creator, when you are, your lifestyle is your business. Let's face it. You're recording content 24/7. You're documenting your lifestyle. You could be working from home. You could be traveling or you went to Europe or Estonia. That's all deductible. Why? You're not going to Estonia for personal reasons. You're going there because you were invited to speak with other entrepreneurs at a conference. So your airfare, your lodging, a portion of your meals, this is all 100% deductible.
But while I was there, I was also sightseeing.
Excellent.
They took me out to dinner. I saw some cool places. We ate at some beautiful restaurants. We also saw Germany on the way. What then qualifies? So where's that cutoff now from being a tax deduction versus not? And then what about me going out and buying Starbucks because I show up at Starbucks?
That's a great point. That's an excellent point. Where do you draw the line? Something you mentioned was you feel confident knowing that we are able to make those decisions on your behalf. Mm-hmm. Consulting and having that open communication, that open channel is extremely important. But we're conservative as well, which means we're not afraid to take the deductions as long as we have the support, but at the same time, we're not reckless. We're not going to compromise any of our clients. Now, we always back out a personal portion of these expenses. Mm-hmm. So for example, your vehicle expenses. We're always going to take out 20, 25% and say, hey, this is personal. This is not business. This was not logged as business mileage. Your trip to Estonia, that when you stopped in Germany, that's a personal portion. We're not going to take that as a business deduction. So we can't say 100% of your trip was business purposes. Mm-hmm. That maybe the airfare was because you were going there for business, but while you're there, the meals, at the end of the day, we're humans. We have to eat, drink, sleep. Mm-hmm. Okay? Is it ordinary and necessary for you to sleep in a 5-star, 7-star hotel? Probably not, right?
What if I'm recording videos in the hotel?
But to be more preventive, we want to make sure that we're going to say, all right, I'm going to take 80% of this as a deduction. I'm going to be fair. I'm going to protect myself, like insurance, like we mentioned earlier in the conversation. I'm not going to say 100% of this was documented. And I've been through these audits. We've had clients who have G-Wagons, private jets, assets that are luxury assets. Mm-hmm. And, you see it on social media. You can write off 100% of a G-Wagon. Yes, the gross vehicle weight qualifies to be written off 100%. But if you're driving that G-Wagon home, or if you're going to your kids' practice, or you're going out on a date with your spouse, that doesn't qualify as a business deduction. So it's just important to be a little bit generous when it comes to the government as well, to say, all right, government, I'm going to take 80% of this as a deduction, And I'm going to show you, look, I've backed out 20%. And I'm speaking this from experience.
Yeah.
I actually showed the agent. I said, look, this was the personal portion that we backed out from meals. This is the personal portion that we backed out from vehicles, the lifestyle deductions. This is what we backed out from travel. This is what we backed out from uniforms, because you're in a very fine suit today, but you can't necessarily write this off because you can wear this to weddings, dinners, private events as well, unless you had your logo on it. But that's a different subject. Now, being cautious of your deductions and making sure that I'm protecting myself between the business use percentage and the personal use percentage is just a way of protecting you.
And so pretty much what you're saying is if you spend $1,000 on something, travel, meals, whatever, you're saying that instead of taking a full $1,000 deduction, you're taking $800. That way it's a $200 is for personal. But now as a creator, right, let's say I'm recording out of my house. It is your life, right? I'm going to be like, if you're a vlogger, you're vlogging your life.
Correct.
So like the stools and chairs in my house, the dining table in my house, the food that I eat in my house, like where do you now, like is everything a deduction?
It's an excellent point. And I'm as an accountant advisor to many creators with millions of followers, I get it. I understand it. This is new. This is new to the IRS. They're not used to this. Just like, crypto is a little bit is new. But at the end of the day, it's ordinary and necessary. And I remember the words of the agent. Is it necessary for this client to drive a G-Wagon? I said, yes. She deals with high-end clients, celebrities. This is part of her brand. And she looked at me and she smiled. She moved on to the next subject. Like I said, it's all about the human relationship. They see that you're doing a good job, you're providing documentation, you're providing support. At the end of the day, it's the story. Can you support your deductions? Do you have the story to support it? As a content creator, yes, you're vlogging from home. But at the end of the day, you need a home to live in. So my advice to you would be, you can't take 100%. That's setting yourself up for failure.
So you're talking about the mortgage now, deducting the entire mortgage.
Yeah, you can't. You could take a portion of your home office. Now, your home office, you could take the standard rate of it's a simplified method rate based on the square footage of your office in comparison to your home. Or you could take the actual expense method, which means you could take a portion of your mortgage, your utilities, your repairs, your construction, part of your interest as a deduction. But it's subject to the square footage of your home. We have clients that say, oh, well, I use my whole house as an office.
I was going to say that.
Technically, that doesn't qualify per the IRS rate rules. But there are many ways, Jaspreet, of avoiding, not evading, but avoiding those rules, where there's the Augusta rule. You can write off 14 payments that you make to your home if you host events or functions, team building activities at your home. So let's say it would cost you, Jaspreet, $2,000, $3,000, $5,000 to rent an event space to host some of your employees in your team for a team building activity. Strategically, you can take, let's call it $2,000 a month. You could do this up to 14 times. Let's call it $24,000, okay? We can call it $28,000. You could transfer that amount every single month, 14 times, to your personal bank account, and it would be considered a rent expense or an event space expense. Now, you could claim that income personally because you've received the deposit, and you would not have to claim it as income because it's called the Augusta rule. This is based on the Augusta, the golf tournament in Augusta, Georgia, where individuals were renting out their home to the golfers or to spectators, people, fans who were watching, who would travel to Augusta, Georgia to watch the tournament, and they were out of their home for, let's say, 14 days. They were able to not claim any of that income as actual income. So you, as a business owner, you want to use your house, you want to write off your mortgage, there are ways of doing that without writing off the mortgage payment you make to Chase Bank. It's, I'm going to transfer and I'm going to actually have a document, an event space lease document between myself, Jaspreet Singh, and my business that I'm going to pay $2,000 a month because I'm hosting my employees, my team at my house for a team building event. and you just wrote off $24,000 to $28,000 tax-free.
It's interesting that you say that, because over the pandemic, I think a lot of ways business has been done has been changed. And I'm not going to say who out of their privacy, but I've done a lot of really cool podcasts and interviews over the years. And more post-pandemic, these podcasts have moved into the influencers' homes. Now, some of these homes are tens of millions of dollars. And so what these influencers have done is they take a portion of their home, their living room, certain rooms, or they build something, and they'll turn that into like a studio, a recording studio, but they'll also bring their team to come work in their home every day. So now you're buying these beautiful homes, but they become now or more of it's becoming an office. And it really is. I mean, they have the studio that's literally like a recording room. You have an office for employees to come in and work. So I guess like just talking about the potential, if you have a business, how you could use that. But even like going back to what we were talking about before, let's say you're making $75,000 a year and you are getting into the cupcake business or whatever it might be, you need an office to, take the phone calls, manage your orders. So you can now also write off a piece of your home, potentially.
The pandemic changed the game, changed everything. It's a leveled playing field now, where the home office was heavily scrutinized. And pre-2020, pre-pandemic, it was one of the most heavily audited items, absolutely, because everybody would just take advantage. There used to be something called URBs, unreimbursed employee expenses, right? Where corporations, you were able to deduct your mileage, you were able to deduct your home office, even while you were working for an entity. But that changed in 2018. So a lot of employees that were working from home weren't able to offset that as an itemized deduction.
Wow.
So that's no longer available. Now, the pandemic changed that because, and unfortunately, even if you're an employee, you still can't write off your home. So writing off your home only qualifies for business owners and entrepreneurs, period. Employees can no longer write off their home as an itemized deduction, okay? Now, back to your content creator friends that are investing heavily in their primary residence that they've converted into podcasting studios or for their business. Look at it from this perspective. If I, as a, at that level, as a content creator, want to purchase a $10 million home, if I want to purchase a $10 million commercial space, and I know the world has changed, I could spend $10 million on a home and a commercial space in one, and I can get the benefit of both. Now, it would be more flexible for you to work from home. You get the benefit of the primary residence, the income tax exclusion on $250,000 to $500,000 in profit, tax-free. But remember, even if you do work from home, what I would suggest is creating a rental agreement with yourself. So your entity would pay rent to you personally or to your LLC of the space per month. It's a legal document. So that way, if God forbid you were to ever get audited, you could present that document to say, hey, I have a rental agreement with myself or with my other entity for this space of my home. Now, yes, you could tap into the electrical, the utilities. You have the backyard, pool. It's a great space for your team, your activities, your hosting guests. It makes you almost want to invest in that. But at the same time, remember, you're depreciating these expenses. So you'll have ordinary expenses, your rents, your insurance, your utilities that you can write off. But it's important that you take that percentage of your designated space and tap into those deductions only. Or you tap into a general rental agreement that you have. But remember, if you're paying rent from your business, you're collecting rent to yourself. That's income. So one way I like to avoid that overall, so you're avoiding depreciation recapture, you're avoiding having to claim that rental income, is the Augusta rule. It's the best of all because you don't have to claim the income. You can say, well, in order for me to have this podcast that I have once a month in a studio, it's going to cost me this much, fair market value. You're able to charge that rate for yourself through your company and not have to claim that as income on the personal side. Because remember, if you're paying rent to yourself, you would have to claim that on Schedule E, which is the rental income and expenses for real estate that you would report on your personal 1040. So there are many complexities in it. If you sell the asset, you're going to have to recapture depreciation anyway. So I feel like the cleanest way of doing it is tapping into the Augusta rule. 14 payments.
Interesting. So yeah, what's interesting to me is the complexity of how deep things can go. Because I think, if like for somebody, if you're making $75,000 a year, I'm gonna keep coming back to this example, you might be very overwhelmed. Like Augusta rule, this, that, depreciation of this, depreciation or capture of that, itemizing these, when practically at that point, it's not a big nominal amount, right? Like all these things, maybe at the end of the day, just a standard deduction might get you better than doing all these things and spending all that money. Versus now, when you're talking about 250,000 or 2.5 million, now they start to be more reason to look. I mean, the complexity of things, or 25 million, now it becomes more ammunition to look for these things. So, like if you're making $75,000 a year, you got a job, but now you're starting your side hustle. I guess when is it worthwhile to consider like the standard deduction versus the, I'm going to spend my time to do this, or hire an accountant to reduce my tax liability to zero?
All of our clients are business owners. We don't work with individuals just to file their taxes. Our niche is just working with business owners. But we do have some high net worth individuals who are executives of companies who are clients of ours. Even if you are a Fortune 500 CEO, at some point in your life, you're going to want to create a business. There's a Chinese proverb that says the best time to plant a tree was 20 years ago, and the second best time is now. If you are an employee, even if you're making $75,000, start your business, start your idea. I know there's a ton of information coming at you. Everybody's trying to grab your attention. But if you can start a business by just simply doing something e-commerce or something hobby related, you are able to, that's the first step. Go after that idea. Create a business plan. Just put your ideas on paper. It could be a one-page business plan. Pursue that passion of yours and try to monetize it. And ways where you can monetize any business that you can create to benefit others will be profitable. Guaranteed. If you are in service of helping others, you're going to make money. Now, starting that at $75,000 is extremely beneficial, where it's just, look, I have one W-2, I work for this employer, I enjoy my job, I like who I work with, I'm happy. Sometimes it's not about how much money you make. At the end of the day, are you happy? Do you have less stress? Is this something that you are passionate about, going to work every day? But at the same time, forget real estate for now, because you have to be at a certain level to be able to invest. You have to have the down payments, you have to have good credit, history of income. Start with that side hustle, that Schedule C. Pursue that cupcake business and say, you know what? My goal is to generate $1,000 in revenue. And my expenses are going to cost me $100. You just made $900 in income. Slowly but steadily start building that business enough to the point where you're like, wow, I really enjoy this. I feel like I'm working on a business that I'm making money with, I'm helping others, and I may get to a point where I can leave my job and just navigate into the business world. Entrepreneurship is the final destination. There's also entrepreneurship. So you may work with a company that you feel like is growing. The founder has a great vision. I want to be part of this company. I don't necessarily want the responsibilities. I don't want the stress. I don't want the headaches, but I believe in this cause. I believe in this mission. That's, you want to align yourself with visionaries that way for you to grow and succeed.
Tell me about your firm. You built the CommonWealth Group. I know it personally. How did you do this? I mean, you were an entrepreneur yourself. A lot of accountants, CPAs are not. What made you want to study accounting, because that's tough in itself, and then want to go out and build this firm, and then build the firm to this point where, you said you run it for 10 years, which already in that 10 years, you've worked with very successful and only high net worth individuals to make such an exclusive clientele. People who are, like you said, flying private jets are coming to you. How did you build that type of firm?
So I started the firm when I was 23 years old.
Okay? 23?
23 years old. I went the pre-med route, similar to your story, right? And then I took a biology class and organic chemistry, and I realized, man, this is just not interesting.
Yeah.
And, prerequisites weed people out. Yeah. And it actually worked for me. I took a business law class. Now, I worked at my uncle's clothing store in Northville, Michigan. It's a custom clothing store. His clients are top 1.5% of the country. We're talking about executives, coaches, CEOs, sport franchise owners. So it was incredible for me to be able to experience what the relationship was with high net worth individuals at the tender age of 17, 18 years old. So after graduating high school, I would work at the shop, and I called it Alexander's University because it was real life experience. And in meeting with these high net worth individuals, it was a unique experience for me because I saw what was on the other side. I was able to sell $5,000 suits to executives at such a young age, and I understood the intricate details of fine clothing and custom suits, and understanding that this is not about sales at the end of the day, and even for our business. And I took those lessons where we are entrepreneurs first who happen to be great accountants. Our mission, I said, if I was going to create a business, being that all of the income, all the revenue that was generated at my uncle's store was not spent by physicians, some were, but a lot of them were entrepreneurs. Some of them were people who didn't even graduate college. They were in the trades, they created a product, and these guys were ultra wealthy. And I remember someone in the city actually donated $1 million anonymously. And this person had a private jet, a helicopter pad, and that inspired me. So I said, you know what? I'm going to tap into the business field. I understood that accounting and finance were the top 2 degrees to have. So I switched from the pre-med route to the accounting and finance route. I went to the University of Michigan. I gained my 150 hours in both accounting and finance. And I said from the beginning, my intention is not to go the public accounting route. I knew partners at PwC, Ernst & Young, Deloitte, Plant Moran. I still know them to this day. And I could have always went that route. But for me, my intention, even in Accounting 101, was we're going to create a firm that's going to deal with high net worth individuals, the fabric of America, the small business owner. And we're going to provide them an unmatched experience that's on a human level. Not an accountant, pocket protector, unhealthy, overweight, always giving bad news. I wanted to bring a sense of life, youthfulness, and energy into this industry. So after graduating, I said, all right, I'm done. I'm going to start my own accounting practice. And just like many entrepreneur success stories, I received a phone call. It was from a family friend who called me, and he goes, Khalil, I'm having this problem with my businesses. I feel like I'm overpaying in taxes. Something is not right. And he's like, do you know somebody that can come into my office, figure out what the hell's going on? Yeah. And I said, Steve, I got the perfect guy for you. He goes, who? I go, me. And he's like, oh my God, did you graduate college? Are you done? Are you ready? Do you understand this industry? I know everything about your industry. I knew whenever there's an opportunity, you have to take it. You miss 100% of the shots you don't take. So I told him, I'll meet you on Monday. I went into his office. I had this proposal. I said, this is what you're going to pay me. And to his credit, he agreed. And he gave me that opportunity. And honestly, that's all I needed to show myself who I was and what I was capable of. But more importantly, show the client that this was the best decision he made. So after requesting documents, I ended up requesting about 2-3 years worth of sales tax information. And at the tender age of 23, 24 years old, I found that he was overpaying $50,000 in sales tax.
Wow.
And his CPA at the time he's a mentor of mine, a great individual. I called their office and I said, hey guys, I'm working with a mutual client and I found this discrepancy, and they hung up in my face. So I was like, maybe the phone disconnected. I always give the benefit of the doubt. I called back and they were being so rude to me. And this is something I'd never forget. They were so rude to me because they felt like I was attacking them, that they made this mistake. But that wasn't my intention at all. It was more like, hey, all right, let's put this behind us. We're all human. Let's recover the funds and have our mutual client receive his hard-earned money back. So long story short, the CPA calls me back. He says, Khalil, great job. This is accurate. Our client received a $55,000 check with interest because it was over a few years. And he offered me $5,000 out of that check. And I turned it down. And I said, I'm not taking a dollar from this because this is what you hired me for. This is what you paid me for. I would set up shop internally. And that meant I wasn't able to open up an office space yet because I was just starting off. When I did that, it showed him that I was a man of integrity, The reputation was extremely important to me. I'm a man of my word, and the results are what I'm after. It's not about the money. The money will always follow. So starting that way, we would grow little by little, all through word of mouth. We never purchased a book of business. It was all organically, all based on referrals. And the highest compliment that you can receive is when somebody refers a family member or a friend to work with you. Then I realized there's a massive void in this industry. That CPA ended up offering me a job. He paid my company. I would work tax seasons with him. Remember, he had 30 years of experience. So he threw everything at me. So I was working on farm tax returns, estates, things that a 24-year-old would never come across. And I know many CPAs who have never come across that in their career, let alone so early on in the game. What that did was it allowed me to take the good, leave the bad from my mentor. But I always said, I'm going to create a practice that's entrepreneurial driven, that is success driven. That is when a client rolls up in a red Ferrari to our office and says, hey, I used to hide this car from my previous accountant because I didn't trust him.
Yeah.
That's the ultimate relationships that we seek. And being able to tap into social media and then start developing the brand organically. Remember, I only got into the social media world a year or two ago, right? I was behind the scenes working at this office like you see here on real life files and accounts and building personal relationships. And then I decided there's a massive void in the market. And if we can help many businesses across the country with their accounting and taxes and teach them about financial literacy and financial freedom, just like you do on the personal side, we're going to do it through the tax side. This creates more prosperity with individuals, with their families, with their communities, to determine how much tax they want to pay. They keep those savings. They invest them in their employees, their business, their communities. They can do whatever they want with it. Because let's face it, the government is spending our hard-earned money extremely poorly. And if we can control and stretch that dollar, we can do it a lot farther. We can do a lot farther than they can. And from my perspective, that's what motivates me. The fact that we are an intermediary. We want to work with the government, but we are also looking out for our clients' interests first and foremost. That's the journey of how we got here. And then we crossed our own paths. I don't know if you...
Yeah, that's a funny story because I was working with a different accountant at the time. Actually, no, we crossed paths before then. And you were very nice. You're like, if you ever need anything, here's my number. Never hesitate to call me. Even if you just want some advice, just call me. I said, okay. I don't think we talked for maybe a year or two. And I always had this kind of like rough relationship with my previous accountant. And the turning point when I called you was I got a call. This was like, I think it was January. My accountant calls me and says, Jaspreet, we screwed up. You got to send in $100,000 by the end of the day to the IRS and like $15,000 to the state of Michigan. I was like, what the heck are you talking about? He's like, oh, by the way, you're also going to have to pay a penalty on this. Naturally, I was a little frustrated. Hung up that phone. I started pacing around my office. I was like, this is so stupid, right? Like, this is so dumb. Like, you have other plans of like where you're going to be investing the money. And that was really the turning point where I was like, I need to find something else. And then I remembered our interaction. And I was like, let me call Khalil. I don't remember where I kept your number, but I had it somewhere saved. And I called you and you picked up. I said, what's going on, Jaspreet? I was like, what's going on, man? Hey, dude, I got a story to tell you. You were like, what's that? And I told you what happened. And you were like, I'm coming to your office next week or tomorrow or something. It was like within the next week, you were like, let me come to the office. Let's talk about this. We went through the numbers and you were like, he's like, you can make a lot of improvements here. And I was like, really? He's like, yeah. He said, let me put together a proposal for you and let's do something. And from there, that was now like somebody who's watching this might have heard me say, if all your tax advisor or your accountant is doing is filing your taxes, you are leaving a lot of money on the table. And that was when I realized, because the approach you took was so different, where your job wasn't to go in and file my taxes. Your job was, now you're looking at the financials, giving me the regular reporting, but then also advising me, saying, you can do this, you can do this, you can do this. This is what your tax liabilities, let's try this. This is a new deduction that was created. You want to take advantage of this? The power is me to do what I would want to do, but you're giving me the guidance. And that, I think, is the big difference. And that's why I asked you, like, yo, can we build a partnership? And which is why anybody who's watching this video, if you want to get a free consultation with Khalil, if your business qualifies, all you got to do is click the form down in the description. But that's the whole idea. I was so surprised when I started working with you that I was like, there's such a need, because I've worked with a lot of accountants before. And that was the big turning point. And it's number one is you got to be knowledgeable, which anybody can be knowledgeable. But then it's how do you apply it and actually look out for the client's best interest and actually provide that care. So that it's very valuable. And it was interesting hearing your story, because I actually didn't know your entire journey of how you built it. But a beautiful man, beautiful suit.
Thank you.
Thank you for coming on.
Appreciate it.
Where can somebody learn more about you, follow you, see what you're doing, and just learn more?
I appreciate the opportunity, Jaspreet. This was a long time coming. As you know, it's business first. I mean, we tend to put ourselves on the back burner. And like you mentioned, these relationships take time. I talk to business owners every single day, from East Coast to West Coast. And they always talk about the same issues that they're having. Communication, they're overpaying their taxes, they're meeting with their accountant after December 31st. And we always say, if you're meeting with your accountant after December 31st, you're too late. Anybody can do bookkeeping or data entry. Like you mentioned, it's all about analyzing and having that proactive relationship. So for me, even if we don't do business together with future clients, I know that will come. And like we mentioned, as long as you're helping people, the money will always follow. The relationships could take a year, could take a day, could take an hour. Like I've been in these scenarios. There's so many times where I've been on the phone and I've talked to the client, and they're not ready yet. They're almost there. And the fact that I say, hey, you're going to be ready at some point. We're going to work together. It's just all about the right timing. And the feedback I get was, look, based off of your approach, based on how personable you are, and that you understand that I may not be ready, that makes me want to do business with you now. And there's been times where I'm like, look, I'm not going anywhere. Like, we're going to be here. We're going to look out for your interest. If your accountant cares, if an advisor cares, that's who you want to be with at the end of the day. Now, how you can follow along the journey, we create, I'm on Instagram, and we're working on things on the back end that we will announce publicly. But I want to provide as much free content and value as possible. So even if you follow the Instagram, it's my name, Khalil Dabaja, you follow that Instagram, I guarantee you're going to learn so much about accounting and the tax code that you can benefit from whether we do business or not. But at some point, we will do business when the client is ready. And that's what we seek. We're growing our firm nationally. So if you want to follow along on the journey by following the Instagram and other things that we're going to announce in the future, it would be our honor.
Perfect, man. Well, thank you for your time. It was great having you. If you haven't already, definitely check out Khalil's Instagram page. Whether you're a business owner, employee, there's a ton of free value that he's putting out there. Khalil Dabaja. I'll link it down in the description. I'm going to put it on the screen here for you as well. Thank you for watching, and thank you, man.
Thank you, Justin.
It was a great time.
Appreciate it.
If your goal is to truly become wealthy, and by wealthy, I mean not just driving around in a paid-off Toyota Corolla, I mean having the nice things that you want, having the vacations, having the lifestyle that you want, you're not going to achieve that by just getting a 3 to 5% raise every year or by maxing out your 401k. I'll show you. Wealthy people become wealthy not because of the income